In July of 2021, Hamilton ETFs came out with the first of its kind all-in-one covered call solution ETF, HDIV, the Hamilton Enhanced Multi-Sector Covered Call ETF, and it was definitely the best new fund of 2021 in my opinion for us income investors who want high monthly income using covered call strategies. The genius of this ETF in my opinion is that since it holds 7 sector-specific covered call ETFs within the fund on an equal weighted basis, you basically get instant diversification all in one fund. On top of that, that 25% leverage the fund uses helps to really boost the yield at about 8.5%, right? That's when it started. So covered calls and leverage without the structure or the risks of a split share fund, simply a dream come true for us income investors. Just when I thought it couldn't get any better or any easier for us, Hamilton ETFs just released a brand new genius ETF called HYLD or HYLD, which is basically HDIV's twin American brother. I really think that HYLD will be the best new Canadian fund of the year for 2022, and I'm super excited about it. This ETF is very similar to HDIV, but the yield target is starting with 10% instead of 8.5%, and it's focused more on the US stock market, whereas HDIV tries to replicate more the Canadian stock market. So let's quickly take a look at this brand new fund together, and then we will talk to the man himself, Rob Wessel at Hamilton ETFs, to discuss all about this fund. So strap in, hit that like button because you will definitely like this video and this amazing new fund, which absolutely without question needs to be in your portfolio if you are a passive income investor. All right, so as usual, whenever you want to do research on a brand new fund or any fund, and for that matter, always go on the official fund's website. So I'm on Hamilton ETF's website here on the HYLD page here. It's pretty much brand new, guys. I mean, it started trading on February 8th. So it's called the Hamilton Enhanced US Covered Call ETF. As you could see, the target yield, what it will start at is, we'll target about 10% yield, which is absolutely phenomenal. Monthly distributions, of course, and it has an equal weight of 7 US equity covered call ETFs, which we'll see in a second. Sector mix broadly similar to the S&P 500. So this fund is pretty much trying to mimic the king of all benchmarks, the S&P 500, which measures the most important 500 companies on the US stock market. And just like HDIV, it will do 25% leverage. So you see that 1.25 here, 1.25. So that's why you really get a nice yield at 25% leverage, right? So here's a cool graph that really shows, basically compares HYLD's index to the S&P 500 itself. And as you could see, the S&P 500 is the gray one and the red one is HYLD, basically with the leverage. Orange is without the leverage. So you could see that it's pretty much neck and neck. So even that it's a covered call ETF, or a covered call themed ETF where you're giving up growth for more income, with that leverage, it really helps to basically give you the same or very close to the same performance of the S&P 500, which is absolutely incredible. We all hear that fund managers, it's very rare for active fund managers and mutual funds to actually beat the S&P 500. Well, this ETF, HYLD, is actually right on par with it. So let's go to overview. Sector allocation is here, and let's explore what funds this ETF holds. It holds 7 on an equal weighted basis, just like HDIV. And once again, just like HDIV, the management fee is 0.65%. So of course, you know, these funds have management fees, and then you're paying an extra management fee on top of that to get access to this fund, which is kind of groups it together. In my opinion, it's worth every penny. Don't forget there's 25% leverage, which helps alleviate the fee. But keep in mind, very important, and I'll talk about it with Rob in a second, the income is net of the fees. All right, so very, very important. Also keep in mind there is a fund on the US stock market called HYLD, the high yield ETF. This is not what I'm talking about here. Keep in mind that although HYLD focuses on the US market, it's a Canadian listed security. It's listed on the Toronto Stock Exchange, not on the NASDAQ, not on the New York Stock Exchange. So very, very important. Also, this particular fund, you have 2 versions. You have HYLD, which is in Canadian dollars, and you also have HYLD.U in case you want to get your income in US currency. So in case you want the US dollars, it's very convenient to get HYLD.U. Keep in mind that both of them, however, are listed on the Canadian stock market. So yeah, rebalance semi-annually. So every 6 months they rebalance it to make sure they're equal weighted. So let's check out the 7 funds in here. So you have, in my opinion, the top 3 best covered call ETFs on the US market in this fund: QYLD, RYLD, XYLD. I called it the Triforce. In my opinion, if you're an American and you want to be an income investor, these 3 should be prime or key in your portfolio. So QYLD, RYLD, XYLD, and we'll check them all out in a second. You also have from Harvest the healthcare, their healthcare covered call ETF. So this will take care of all the healthcare companies. There's a brands one from Harvest, which is all the best brands. HEP, of course, is there, just like in HDIV. This will take care of gold producers. It's very defensive, materials. And then, of course, you have a tech one, TXF this time instead of HTA. So TXF is one of probably my favorite covered call technology ETF. So these are the 7 ETFs. Let's take a look at them real quick. So first of all, you have QYLD, the biggest and most popular covered call ETF on the US stock market, over $6 billion in assets. It's never missed a dividend, very, very high yield. Usually it's between, I would say, 10 to 12% yield. Right now, the trailing yield is 14%. This is the average in the last 12 months because the December or the last distribution for 2021 was really, really big. That's why. But my opinion, it's about 10 to 12%, consistently 10 to 12% yield, maybe a little bit higher. If we open the fact sheet, you could actually see the sector. So obviously QYLD, everyone, as we know, follows the NASDAQ 100 index. So the NASDAQ 100 index is the top 100 companies in the NASDAQ, excluding financials. So obviously technology companies are going to be the biggest chunk here, but you have other stuff like communication, healthcare, consumer staples, industrials, utilities. Then you have the Russell 2000, which is a really, really cool index that's not talked about much. This is an index that covers 2,000 of the smaller to medium-sized cap companies on the US. I think of it like the heart of America. And this one, just like QYLD, has a very high yield, always between 10 and 12% usually. Never missed a dividend payment. If we look at the allocation breakdown, you have a very, very well diversified financials, healthcare, industrials, tech, etc., etc. You even got some real estate in there. So this is the Russell. And then, of course, you have XYLD, which is the S&P 500, right? The king of kings when it comes to index investing on the US stock market. So this one, the yield is a little lower than QYLD and RYLD. This is why personally I don't own this one on its own, but still a very good way, in my opinion. If you're an income investor, you want the S&P 500. This is basically VFV with covered calls. Okay, so you're giving up the growth for the high monthly income, and you're looking at about 9 to 10% yield with this one. So if we look at the breakdown, obviously it's going to be very high in tech. This pretty much mimics what the US market is. So technology, healthcare, the 2 biggest ones, and then you have some other stuff in here as well. So very, very diverse. So these 3, QYLD, RYLD, XYLD, are listed on the US stock market. But keep in mind, guys, HYLD, I keep getting these questions. Is there a 15% withholding tax? How is the income going to be taxed? It's Canadian listed. So even though it has some US listed funds, US companies inside it, there will be no 15% withholding tax to pay because it's Canadian listed. That 15% withholding tax is all included in the fund. It's taken care of by the fund manager, so you don't have to worry about it. And I'm going to talk to Rob Wessel about it also. So moving on, there's the Harvest Healthcare Leaders Income ETF in there. So this is basically 20 of the best, of the biggest pharmaceutical companies in the world. So you have things like Bristol Myers, Eli Lilly, Johnson & Johnson, of course, AbbVie, United Health Group, Pfizer, of course, AstraZeneca. So, and also a bunch of other companies that are medical device companies as well. So really the best of the best when it comes to healthcare with HHL. That's one of the 7. Another interesting one is the Harvest Brand Leaders ETF. So, HHL is an HDIV. as well, but this one is not in HDIV. So brand leaders, I kind of like this ETF. It's the best brands in the US. So the best, companies that have very, very strong brands. So you'll recognize all the companies I could assure you in here: Apple, Visa, Google, McDonald's, Walt Disney, Intel, Johnson and Johnson, Microsoft, Nike, Pepsi, UPS, Procter and Gamble, Caterpillar. So really the companies that have very, very powerful brands. So these are the two ETFs within HYLD. Then of course you have the TXF, which is my personal favorite cover call technology ETF, where you have, this is pure technology. So if you go to holdings, you'll see all the technology companies in here. So you have IBM, Apple, a lot of chip makers as well, not just software. So Qualcomm, Analog Devices, Broadcom. I like the fact that they put Amazon in here too. AMD, another chip maker, Cisco, Nvidia, a network, Cisco, Nvidia's chip maker, Intuit Software, Salesforce, Facebook. So all the, my 25 of the best technology companies. And then of course you have HEP from Horizons, which is Horizons covered call ETF for gold producers. So if you go to holdings, you'll recognize a lot of the, it's just the biggest gold producers out there: Newmont, Franco-Nevada, Wheaton, Royal Gold, and Yamana Gold. And this is just the top 10. There's a few more. So that in a nutshell is, the breakdown of these 7 ETFs. Amazing fund. Now let's talk to the man himself, Rob Wessel. Here. All right. So Rob Wessel, once again from Hamilton ETFs, is joining us today. Thanks again for doing this, Rob. I really appreciate it. We will talk about a couple of things here. So a few things I want to really touch up on is HDIVs Success. And then, of course, we'll talk about the brand new fund that I'm extremely excited about. And so is the audience, HYLD. Thanks for joining us again, Rob.
Oh, no, thank you very much for having us. And we really appreciate it.
Yeah. So let's start with HDIV. HDIV has been out for maybe 6-7 months now. It passed $130 million in assets. So I think that's, I'm not really a fund manager. I don't really know these things, but I think it's a really, really good success story. So are you surprised at all at the success of HDIV?
Yes, actually, before I forget, before we have our conversation, sure, I should direct people to our website, to the legal section and the disclaimer for our firm, because there's just for background. So we, as you know, HDIV is a very, is a unique product. It was the first of its kind that we're aware of. In fact, it was the first of its kind. So we really didn't know how it would be received. So it's actually been a pleasant surprise. It's been great. We appreciate, people like yourself who have taken an interest in it. And while I'm not allowed to talk about performance, I think we are pleased that in the first 6 months, HDIV has acted in a way we would have hoped it would have acted, given the market environment.
Yeah. I love that fund. I mean, I always tout it as an all-in-one covered call ETF. The dividend has been very, very stable. It's a monthly dividend. It's been completely stable at $1.41 annually. Or is there any plans on increasing it, or do you think the dividend's pretty much there to stay? I know it's based on what the 7 funds in the ETF is doing. Yeah. So
yeah, I think we'd have every plan to increase the distribution. We are trying to make sure that the distribution, broadly matches, the average of the 7 ETFs. There has been some increases in the distributions of these constituents, but yeah, we would expect. I can't say when the next one will be, but we definitely feel that the fund its distributions will grow with the distributions of the underlying.
Oh, that's great news. That's fantastic. I'm sure my audience will be excited about that. Yeah,
it's not a fixed distribution.
Okay, cool. So perfect. So all right. Well, congratulations. I mean, you deserve it. It's the first fund of its kind. I was very excited when I saw that fund. I think it's genius. It's kind of a one-stop shop for income investors like myself, where our bread and butter is really the covered calls. And speaking of bread and butter and excitement, you just announced recently a new fund called HYLD, which seems to be very, very similar in style to HDIV, but more to replicate the US side. So tell me all about this fund. What made you come up with the idea for this fund?
Yeah, well, I mean, for lots of reasons. The first one was, the success of HDIV. We wanted to get that to a place where we were comfortable thinking about, what could go with it, what would be a companion fund. We had a lot of people ask us, would you consider doing a US version of that? So there was a lot of inbound interest. So we got to work and tried to come up with what we thought would be a portfolio that was broadly similar to the S&P 500. So recall HDIV, we were trying for a sector mix that was broadly similar to the TSX 60,
Yeah.
albeit it's a little bit skewed towards higher yielding sectors like utilities. Here, we were trying to find a sector mix that was broadly similar to the S&P 500. And again, really what we're trying to do with both HDIV and HYLD is almost synthetically create an income version of these two benchmark indices without really sacrificing total return or the underlying return. Because as we know, one of the benefits of covered call products is that they do have higher yield, but we know that to a certain extent that comes at there's a yield return trade-off. So they don't always grow quite as quickly as the underlying non-covered call equities. So the purpose of the leverage is just adding a little bit of leverage, just modest, 25%, but enough that we felt could not only enhance the yield for monthly distributions, but also to mitigate that yield return trade-off. So that, if you look at the returns of HDIV and you compare them to XIU, which is, famously low fee, single basis point or whatever it is, ETF, you can see the returns of HDIV after 6.5 months, and or whatever it is since July, and you can compare it to XIU. And the same over here in terms of trying to get something that had returns broadly, pretty similar, in line with the S&P 500, but giving you, what we think is very high or attractive monthly distributions.
Yeah. I love that leverage, that 25% leverage. Like you say, it really compensates for not only the management fee, which correct me if I'm wrong, is also same like HDIV 0.65, 65 basis points. So it also helps to mitigate that trade-off, like you said. So covered call strategies, like we know, they're primarily designed for income, because you're giving up potential growth, especially in strong bull markets, for more income. So I really like the idea of that leverage. So let's talk a little bit about the constituents inside. The first thing I noticed, and first question I want to ask you, is for the tech ETF. So in HDIV, you have HTA, which is from Harvest. And in this one, you have TXF, which is personally the technology covered call ETF that I hold. So what made you decide to go with TXF instead of HTA for HYLD for the new fund?
Well, there's lots of reasons. I mean, they're pretty similar. A higher yield and a larger AUM, and maybe we gave up a little bit on the return, but we were okay with that. We also want a clear distinction between HDIV and HYLD. We call it HYLD, but there was no. It was, generally speaking, we were trying to put holistically thinking of all the ETFs together. They're based off of, we have or Solactive has an index, which you can see on our website, to show the returns of these 7 covered call ETFs. And the index, and then what is the return of 1.25 times that index, which hopefully over time would is the objective of HYLD, is to track that. And so putting these together with the individual constituencies, that actually worked out quite well, and the returns were very, very close. So it wasn't really about one particular ETF. We also wanted a diversification of managers. As you know, there's 2 Harvest ETFs already in HYLD.
Correct. Yeah. So that's one cool thing I saw on your web. You did just like HDIV, right? You compared it to the TSX 60. So correct me if I'm wrong here. This index of the 7 covered call or HYLD with leverage is pretty much on par with the benchmark of all benchmarks, the S&P 500, right? So
times 1.25, yes.
1.25, yeah.
Yeah, there's a bit more coverage in on the covered call strategies underlying HYLD. So the 1.25 gets you closer to the S&P 500.
Yeah, and that makes sense. I mean, your target yield for this ETF is 10%,
Correct.
which if you look up the average yearly performance of the S&P 500, it's usually, depends where you look and different opinions and time frame, it's usually about 10%. So you're right there. You're pretty much replicating what the S&P 500 does, which is the king of kings when it comes to, benchmarks, and it's always the number one passive growth index ETF. Warren Buffett talks about it all the time. I think he says his family's mostly with that ETF. So really, really, really cool. And just going back to the constituents. So QYLD, RYLD, XYLD, those are the US listed ETFs.
Right.
And I always tout them as the 3 best covered call ETFs on the US market. And
Mhm.
those are, unlike Harvest and the other Canadian listed covered call ETFs, those have a more aggressive covered call strategy. They're at the
Right.
money, so the yield is higher. So tell me about
Correct.
your decision to include these ones. And what do you think about these three ETFs? In your opinion, are they really the best of the best when it comes to the
Yeah.
US?
So that's a great question. You might be surprised to know the actually the universe of covered call ETFs in the United States isn't particularly large. So
I did
Canada,
notice that. Yeah.
in Canada, there's tons of covered call ETFs. So there's, when you're coming up with HDIV, the amount of things, like the breadth of ETFs that you can choose from, as you know better than anybody, is quite high. In
Yeah.
fact, in the United States, there isn't as many to choose from. So having said that, Global X is a great firm. As you know, it's a sister company to Horizons in Canada. But those ones there, again, thinking about those three plus the other four, gave us something that was very similar to the S&P 500. But it did, as we all know, everything is a trade-off because they write more aggressively at the money and a greater percentage of the overall ETF. The targeted yield is higher. In this particular case, in order to replicate the returns of the S&P 500, because this is a bit more aggressive and weighs more on the upside, the modest leverage is a little more instrumental in getting you closer to the S&P 500.
Yeah, and this is one of the reasons why I'm so excited, because QYLD, RYLD, XYLD, those three, I call it the Triforce sometimes, and I tell my Canadians audience members, if those are literally the best ones to put in your RRSP, because in the RRSP there's no 15% withholding tax on the income from US listed funds. So this is why I'm extremely excited about HYLD, because it's finally a way for us Canadians to get access to those three ETFs, and we could put it in our cash account, in our TFSA account, without having to worry about paying that 15% withholding tax. So this is always a big question I get. So my question to you is, can you confirm that yes, this fund HYLD is Canadian listed, so there will not be a 15% withholding tax for the user? It's included in the fund, right? It's taken care of by the fund manager.
That's right. So the distributions, or the 10% targeted yield, is taking into account that the withholding taxes have already been paid. So the 10% targeted yield is indeed 10% without withholding taxes, because that's already been withheld at source. I should actually mention, before I forget, that we're actually offering HYLD in two forms.
Right.
First, it's HYLD is going to be Canadian dollar denominated and also hedged to CAD, the Canadian dollar. And we're also offering HYLD, or HYLD.U, which will be US dollar denominated. The distributions will be in US dollars and it will be unhedged. So for those people who want pure US dollar exposure, we got that. And if you want US market exposure, but you don't want the US dollar or the currency risk, then we have that as well.
Yeah, pretty good. I mean, a lot of these types of ETFs, they have US currency, Canadian currency version, but just to make it clear, they're both listed on the Canadian stock market, right?
Yeah.
Okay.
We don't have anything listed outside of Canada. Everything we have is listed on the Toronto Stock Exchange.
Okay, perfect. So going back to taxes a little bit now, since there are three US listed ETFs, one of the questions I always get from audience members is, how will the distributions be taxed? So this is a fund that holds 7 other funds. So I'm assuming it's going to be a combination of different things. So of whatever the 7 ETFs give out as income, correct? Correct.
Yeah. HYLD is essentially a flow through. So it would have, as you know, all funds have multiple components to it, whether it's Canadian dividends or dividends Canadian, which are entitled to the dividend tax credit, whether it's US dividends, which are treated like foreign source income, whether it's capital gains, or whether it's ROC. This will have the same components. The difference being is because the underlying are US securities almost exclusively, then it will be the composition will have more foreign source income, less dividends, but still have, we'll call it good ROC, and capital gains.
Okay, cool, perfect. So honestly, that's all the questions I had. Once again, thank you for creating these awesome funds for us Canadians who want monthly income. This is like HDIV, it's going to be monthly income. Target yield is 10%. I mean, it's pretty hard to get 10% return just overall, but this targets 10%. It's an income strategy. It's monthly income. So I just want to say, on behalf of all my audience members, thank you for creating these all-in-one funds. Any plans for any new funds coming up? I know I always ask every fund manager, they can't say anything, but any plans coming up?
I think right now, so we launched an enhanced or modestly levered Canadian banks and insurers ETF a couple weeks ago.
Yes, I did see that.
That's off to a very good start, and we're launching HYLD on the 8th. And so I think we're good for now, but we have lots of ideas that we're working on. But right now, we're focused on trying to make sure that these ETFs get off to a good start, and that that we can make them good and attractive products for everybody, including your followers.
Yeah. So going back to that new ETF, it's HFIN, right? HFIN. Right. So that's kind of like very similar to one of your very, very popular Canadian banks ETFs, HCAL, which is the 6 banks with a mean inversion strategy plus 25% leverage. So HFIN is literally, you're going to have the 6 banks plus other financials in Canada, like the life insurance ones. And there's even Brookfield, I saw was in there, Power Corporation. Yeah. So I think of it like, both HCAL, HFIN, I think of it more as a dividend for dividend growth investors that don't want the covered calls. They don't want to cap their capital appreciation growth, but you have a nice 5% yield with those. So if ever, I'm talking to my audience here, if ever you're more of a dividend growth investor, not really into the covered calls, I strongly suggest Hamilton has 2 really cool solutions: HCAL for the 6 big Canadian banks, and HFIN now, which is brand new, that has the 6 banks plus the insurance company. So also some cool funds there. So,
so if you're, depending on where people are on, I mean, the one is the HFIN is just more diversified. Also, depending on what happens to the interest rate environment, insurance companies are not as expensive. They might be a little more timely right now. The banks have obviously done very well, and we'd expect continue to do pretty good. And also, if we think the long end of the curve, long rates will go up, in that type of environment, the insurance companies should act quite well. So there is an element of diversification by HFIN having all 12. I mean, everybody knows the banks, and HCAL is the top performing Canadian bank ETF by a pretty wide margin. And it's done extremely well. It's well over a year old. HFIN is basically HCAL, but a more diversified version. So we're actually pretty excited about that one. And if interest rates go up, the long end of the curve go up, that'll be a good environment for HFIN.
Yeah, for sure. It always helps financials, right? When interest rates go up. So perfect. I think you have great funds. And thanks so much for doing this once again. If there's anything you wish to add or say, you could go ahead. But I'm good with the questions.
I mean, you have a great channel. We really appreciate.
Thank you.
We really appreciate everything you do, and we appreciate your interest in our funds. And I can tell you, very few firms can tell you or know as clearly as we do your following, because every time you talk about us, our website goes crazy with visits and stuff. So that speaks to obviously the influence and large following that you have, and we are very grateful. That you've taken an interest in our funds and spent time understanding them, because not all of them are, they're not as easy to understand. They're not so obvious, right? So they take a bit of work, and so the fact that you've done that is to your credit, and we appreciate it.
Well, I really appreciate that. Thank you very much. And my channel, my investing style is all about passive income. So these are really, you have the perfect ETFs for that. So thank you for creating these ETFs, and hopefully we'll get more. I mean, I'm always on the lookout, on the hunt for more of these funds, and these are just special to me because they're all in one. It's a one-stop solution for someone who loves the covered call strategy. So thanks again, and I appreciate it. And come back on anytime if there's anything new. You let me know, and we'll have another discussion.
We definitely will. Thank you so much.
Thank you. Thanks for watching, everyone. I hope you enjoyed that fund manager interview. I have a lot more coming up in the future, so make sure to stay tuned. Please show your appreciation. Hit that like button, hit that thumbs up button. I would really appreciate it. It takes 2 seconds and it helps the channel grow. So it's a win-win. Also, since I have a lot more great content, including fund manager interviews coming up, make sure you're subscribed to my channel if not already done, and hit that little bell next to the subscribe button so you're notified when a new video comes out. You don't want to miss it. And don't forget to visit our website, passiveincomeinvesting.ca. That's where you could purchase my digital product that I'm very proud of, the Ultimate DIY Investing Package, which is on version 3 right now. You only have to buy it once because it comes with lifetime updates. Don't forget that. So this product is really a reference tool, a companion tool to really help you build your own portfolio according to your investing goals and needs. And it's good for Canadians and Americans as well. You have sample portfolios for both the Canadian stock market, the American stock market, and my intention is really to do at least at the bare bone minimum an annual update. So make sure to pick it up because it comes with lifetime updates. Also on my website, right there on the homepage, I do offer a one-on-one consultation service with me personally. It's a 1-hour Zoom call. In case you want more personalized help here, you could ask me all the questions you want. You could, I'll help you, I'll analyze the situation, help you build a brand new portfolio, help you transition to an income-focused portfolio, analyze your portfolio according to your needs. Whatever you want me to do, whatever help you need, I am there to help you. I absolutely love meeting people all around the world and doing these one-on-one sessions, but I gotta limit myself to 4 a week because I need the time to create obviously more YouTube content. So I know they sell out very, very quickly. I get emails all the time from you guys saying, you know, can you put me in? Can you put me in? I always miss the appointment. I apologize for that. There is a high demand for the one-on-one consultation. So like I said, I got to limit myself to 4 a week, but make sure you're subscribed and make sure to join our Facebook group because I make the announcement whenever the calendar becomes available or the new appointments open via YouTube community post and via Facebook. So join our Facebook group, Passive Income Investing. We have a nice Facebook group, almost 10,000 members. It's a nice group where everyone just puts their questions and we all try to help each other out. You could put your portfolio to get opinions. So don't be shy. Join our Facebook group and join us there to really share in the knowledge sharing, right? It's a great group. We're also on Instagram. If ever you want to know more about our personal day-to-day life, you could follow us on that social media platform if you use it. My mission, the mission of this channel will always be the same. It's to help everyday, normal, regular people to invest on their own, to build their own stream of passive income, to enhance their quality of life, and one day become financially independent. There's no greater feeling in the world than financial independence. Trust me. So continue to stay safe, everyone. Stay healthy, and of course, stay passive. See you next time.